Investors await Thursday's critical July CPI print. My next guest says she expects to see more disinflation, which could mean the end of the Fed hiking cycle. Joining me now here at Post 9 is Gabriela Santos of JPMorgan. Good to see you.
Good to see you.
Certainly the market is poised, I think, to expect more disinflation, have that story unfold a little bit farther. Now, how low we get in terms of inflation rates, who's to say, anytime soon. What do you attribute the yield move higher to if it's not necessarily about Thursday's CPI?
So I do think we do think soft landing hopes have really been justified. The probabilities have moved higher. The real economy side is looking good. Demand is just normalizing, not collapsing, at the same time that you have this disinflation process. And we do think it'll continue without the Fed needing to tighten policy further. So really, it hinges on that disinflation continuing and lessening any kind of policy-induced recession odds. But I do think it's been interesting to see long-end yields move higher. Really, since early May, they've moved higher by 70 basis points. And it's not really about shifting Fed expectations because the 2-year has gone nowhere during that moment. So it seems to be about 20 basis points higher inflation break-evens, maybe just related to commodity prices moving higher at that time. And then real rates, it might be a combination of just technicals in the bond market, a little bit less demand from foreign investors, and a lot more supply, as we heard last week.
And if that's the case, you do have the opportunity to capture real rates in longer-term bonds right now. I guess the question is, does it create a real restraint on the economy beyond just a nice soft landing? And can the stock market digest it okay?
So I think it's been happening for over 3 months, and the stock market just did not care.
Sure.
It was happening in the background. And I think it was just the suddenness of the move last week, where at one point 10-year yields had moved up nearly 30 basis points in just 1 week and had reached that near 15-year high level of 4.2%.
Crossed above 4, yeah.
Exactly. So I think it was that suddenness of the move. From here on out, I think it depends how long we stay at these levels. We don't think for very long, which is why you want to take advantage of it by leaning into duration. And I think it's why it's happening. And critically will be to watch those inflation break-evens. Do they keep widening? And then all of a sudden we throw into question the disinflation narrative, the Fed narrative, the soft landing. Or is it just about bond market technicals, in which case stocks can go back to ignoring that move?
Exactly. So if you think the Fed won't have to tighten further from here, and let's say that's the case, you'll have some folks come and say, well, you know, it's about 6 months after the last Fed rate hike that you have on average a recession scare, if not worse, or, you know, stocks tend not to bottom, so to speak, till after that. Can we really put a lot of credence in those things? I just wonder, because it seems like this whole cycle's been kind of scrambled in terms of, you know, the cadence of how markets have behaved with regard to the Fed.
I think you're totally right. It's not a normal business cycle in the sense that it was really driven by the pandemic, and we have all kinds of distortions happening, which is why we came into this year expecting a hard landing, expecting a recession, and we've had to revise that now, given the data. I do think soft landing can get extended into next year because we've gotten 2 really interesting pieces of information over the last, let's call it 24 business hours. First is better improvement on the supply side of the economy. We got that on Friday with productivity moving higher. So that means that unit labor costs are moving lower and you can continue to see disinflation. And the second one is the interview with the New York Fed President, John Williams, with the New York Times, suggesting that the Fed can lower rates next year because they're focused on the real rate. And you don't need a hard landing to have rate cuts. So the Fed can help land this plane together with the improvements on the supply side.
Yeah, it's absolutely kind of kick-started that storyline again. Of course, the market has been projecting the potential for rate cuts, but maybe that was just seen as an insurance policy against the downturn in the economy, as opposed to the Fed saying we don't have to keep them up here that long.